I want to hear somebody come out and say the markets are volatile because the world is unsteady. That's what's going on. This is normal, and your viewers should not panic. It's an opportunity to make money. I mean, this is a volatile period that's very typical. Absolutely. These periods of volatility are very ordinary. Why is it happening now? Because the three biggest economies in the world are having trouble. It's not like 2/3 of the world is off this week and they're not minding their portfolio. We're in a very volatile period, and coincidentally, it's Christmas week. And it's going to continue into the new year until we've sorted a few of these things out.
I don't think there's as much of a financial market imbalance. The only one that we could probably point to that we have been keeping our eyes on has been this favoring of the market for growth-oriented businesses. That's been represented in the FANGs. That's been represented in the number of unicorns that come through the private equity side of the equation. You see similar sort of companies in smaller cap areas. You even see it abroad to some degree. Basically, an overwillingness of investors to pay for growth, pay for companies or invest in companies that effectively have zero profits right now, give them a lot of money, and hope that everything works out.
Our confidence that we're going to soon be on the other side of this volatile market is increasing as inflation comes down, interest rates coming down, valuations should go up. We're at 14 times earnings. That's pretty inexpensive as long-term interest rates are coming down, so the discount factor is coming down. And I do think that China stimulus is going to surprise. I think this is very healthy. It's not just monetary policy. It's not just debt. I actually think there's going to be some very strong demand coming out of China, and that will influence the rest of Asia as well. Banks are also in the process of being disintermediated, and they're also facing the flattening yield curve, which we don't think is a bad thing. We actually think the yield curve will invert. This is going to be very problematic for financials, and the reason it's going to invert is because inflation is going to surprise on the low side of expectations, while growth surprises on the high side of expectations.
In markets like this, it's tough to make a valuation case because markets that are oversold can get more oversold. But I think we're pricing in a pretty bad scenario for 2019, even relative to our more sort of bearish 2019 assessment, because I think credit markets have sort of lost their luster, if you will. Credit took a long time for corporate credit markets to actually react to equity market vol, and now we're seeing the corporate loan market start to take some nicks, and the corporate bond market as well. Spreads on high yield are now closing in on 500. They pulled back a touch over the past couple days. And in fact, the pullback in high yield spreads is one of the reasons why I think we get a little bit of a rally in equities. There are a number of risks out there. I think we've got Europe. I think Europe is an issue. I think we have a repricing of sovereign yields in Europe, mostly around an Italian catalyst. I think U.S. housing has started to weaken. And as I just pointed out, I think the corporate bond market and the corporate loan markets here in the U.S. Are going to have some difficulty.
Bull markets last 14 plus years. We're 9 years into this one. I mean, the 1949 to 66 lasted 17 years. The 1982 to 2000 lasted 18 years. This past 2 weeks is just noise. You've got tax loss, mutual fund liquidation, and hedge funds sent out letters to investors on November 15th that gives them through December 31st to liquidate their hedge fund and redeem their money from the hedge funds. So I think you were selling into a vacuum. Nobody's around. I don't think you're going to know the real destiny of the market until you get back into mid-January. I still think we're in a secular bull market that has years left to run.